Well, good morning, everyone, and thank you for joining us. You guys are in for a treat. Every time I spend time with Karen and chat, I always feel a little smarter, sometimes a little more panicky about the world. I think we're at an interesting inflection, and so we're going to jump right in. So let's start off by talking a little bit about the current microenvironment. In your recent research, you say that we're at an inflection point. Tell us what you mean by that.
Well, first, thank you. It's great to be here in this, huge center, and feelings very much mutual about every time we spend time together. And, I've used this term inflection point because if you look at the last 15 years or so of investing, they've just had a very certain tone that stands out relative to history, where pretty much being a passive investor and holding a very traditional 60-40, 70-30 was unbeatable. And it stands out historically. It's like the best 15 years you've ever seen for that kind of investing. And it's for reasons that can be understood, because we came out of the great financial crisis with the world sort of needing this period of healing, needing this period of lots of liquidity and easy money, and having a lot of room to run with growth, with inflation, without there running into any issues, and with kind of pretty good valuations because you came out of a crisis. And so we got used to this world where anything you did that was in any way, shape, or form diversifying to a very standard allocation hurt you. So the more it was different from a standard 60-40, 70-30 allocation, the worse it was. And that's in our bones now. We've just lived through 15 years where anything diversifying was just worse, and the simplest, most passive, easiest thing was best. And so it feels to me like we're at an inflection point because we're at a spot where we all know it's a different world that's ahead of us than behind us, right? We're definitely not in a world where we need to deleverage anymore. The private sector is in good shape. A lot of debt has moved to the public sector. We don't know where all that public sector debt, when it's kind of going to come to roost. But probably most importantly, the tools we're going to use to manage the economy have changed, right? Trump and his team are accelerating this paradigm to kind of a mercantilism, protectionism, industrial policy world. And let's be honest, valuations are not what they were coming out of the financial crisis, because what happens when you have great returns is that gets priced in and expected for the returns later. And so the range of outcomes of how the world might look, what part of the world might do well, what assets might do well, it's just different than it was. And yet it's in our bones, it's in our body, being used to these last 15 or so years where we really basically got rewarded the more we just invested passively, easily in equities. And so it feels like a really important inflection point to ask what should be in the portfolio and where's the world going to go and how's that going to affect the assets that I own.
I think that's an incredibly important point, because I do think we tend to stick with whatever has worked in the past until it looks like it's not going to work. And so here we are at a point where, clearly, to your point, things are changing, right? And I do think there's a real sense of equities and growth working because we were in a global world where there was some natural cost cutting, and now here we are in a protectionist world, not just in the United States, but all over the place. And as a result of that, do you think that we have to think of all of the different markets individually, or we have to think of it as a global package of how we want to put these things together?
Do you mean in stocks or just broadly?
I mean the world. Part of one of the things that we've done in the past is, to your point, just buy U.S. That's all. If everybody just bought U.S., that worked. Any diversification away from the U.S. hurt. So how should we think about that now?
Well, the U.S. it's a great example, right? Because so everyone's concentrated, and everyone's done, as you're saying, what worked. And what worked is pretty much buy equities. Within equities, more and more U.S. The U.S. is 2/3 of global market cap, more like 75% if you don't have a lot of EM. And then within the U.S., more and more concentrated in a really small number of companies, right? So concentration is kind of at historic highs. And we're in a spot where, on one hand, you could say, but isn't that justified by fundamentals, right? U.S. companies, they've actually been so much better than foreign companies at producing the profits, at actually returning money to shareholders. Their earnings have just been so much better than you've seen elsewhere. At the same time, that's very much in the price. And so when I do sort of a break even of how much do you think US earnings need to grow in order for you to say, I just broke even relative to just buying a bond, because we're also not in the same place with interest rates, right? There's a positive real interest rate, and you can make a lot of money relatively risk-free. I'd say you probably need like 9% EPS growth in the US, which is not impossible. It's a high number. It's high relative to history. It's not impossible. But in most other countries, you probably need 2, maybe 3%, so meaningfully lower. So the bar for the US to keep being the outperformer has just, really risen relative to what it was because of this period of massive outperformance. And, going back to your question, it was just, okay, so we've been in this thing. People like doing what worked. I think that it is a really good time to sort of step back and say, how do I think about my vulnerabilities across many lenses? The geographic lens is one good one to look at because everyone is just so US concentrated at this point. And when I look at what really ends up driving asset performance over time, like when you look over a 5, 10-year period and say, what makes assets generally do well? It's usually very macro stuff, right? It's usually things at the level of, is liquidity being provided? Can policymakers ease? Is this a good time to basically be holding risk premiums and earning them or not? And what are the starting valuations? And if you line up the US relative to other countries on these dimensions, it kind of looks the same as other places. It kind of looks similar. It doesn't really stand out. It has worse valuations. It has some better monetary policy backdrop. It kind of looks about the same. And so the way I would think about it is that when you start out saying, I'm starting with the US being 75% of my allocation, you are effectively taking a really big bet that you think the US will radically outperform to give up all the diversification for all the other countries in the world. And that might make sense in a certain context of governance, but it also is good to just acknowledge that's what's going on. That's a big bet. It should take a lot of expected outperformance from an already very high level of 9% earning growth versus 2 to be willing to be so concentrated in one place versus get the benefits of diversification.
So that's clearly, to your point, a big bet that most portfolios are taking right now. How should we be thinking about this differently? If you believe that this is a huge risk, which clearly it is, it may work out, but it's a huge bet we're taking. What things should we be considering to reposition our portfolios?
So I'd say first, at the highest level, I think there is a revolution that's going on in portfolio management, where when I look at all of our clients across the world, the traditional way of doing things was very much a strategic asset allocation. Like you go over some period of time, you decide on your strategic asset allocation, you have your buckets, you have some freedom within that, but effectively what you're really saying is like my building block is the asset class. And I start at the top and I say, what asset class should I hold? And I have a little bit of freedom within that. And I think there is a big revolution happening of people wanting more flexibility, more ability to see their portfolio as one integrated whole, and recognizing the issues with just thinking in asset class terms. They leave you sort of not very dynamic, and a lot of the big decisions fall out of that rather than being made explicitly. And so when I look at a portfolio, a lot of the biggest drivers of whether it does well or poorly are basically how risk on or risk off is it? Is this a good time to take risk? How much risk is that portfolio taking? If you're thinking only in asset class terms, it sort of falls out. You're not really making that decision at top of house. It's kind of falling out of a lot of decisions that are being made more in the micro. And number two, what's the macroeconomic environment? Does it benefit, for example, growthy companies, or does it not benefit growthy companies, which is also a decision that's kind of being made in the micro. And so part of the shift, in my view, is being able to look top of house and say, what tools should I use to understand everything across the asset classes, and not let every asset class talk in its own language and think about risk and the environment in its own language, because it sounds very compelling in the context of private credit to talk in a certain way and public equity and private equity talk in another way, but put it all together and say, top of house, what are my risks, and therefore, what do I want to do about it? Now, I think once you look at your whole portfolio, possibilities kind of start opening up, especially in the context of whatever it is, governance that you're sort of wedded to and you think about. But a couple of things I'd point out. One is within equities, I think you definitely get a tough time to be asking, how much do I just want to be in the market cap versus what is my freedom to be more resilient to different things? Yesterday, market action is just such a good example of this, right? Because you look at something like, how will AI development affect a small handful of big tech companies? Will they be the winners from AI? Will someone else be the winner from AI? That's a very idiosyncratic question at some level. And if you just hold the market cap, you have a lot of exposure because there just happens to be the really big companies. So what does it mean to be an equity holder that's more resilient to different ways that AI might evolve and might affect the economy? What does it mean to be resilient in different ways geopolitics might work out? All this leads you to basically saying, can I hold my equities in a more resilient way, not just market cap? And the second thing is that, kind of top down, a big decision I think was being made at the top of the portfolio level over time was to shift out of fixed income. And that made a lot of sense in the context of rates being zero. Rates couldn't really play a meaningful role in the portfolio. When rates were zero, if there's a big downturn, what's the Fed going to do? Rates are already at zero. That's no longer true today. So the question of what kind of protection do I want in a growth downturn, you can actually look at something like bonds again, and I think thinking about rebuilding those bond allocations is a big issue. And then the third issue I'd call out is currencies. I think when you look top down, you sort of look at your portfolio and you suddenly say, wait a minute, I'm inheriting a lot of currency exposure when I do buy foreign assets that I may not have actually thought through. I may not have actually said, I find that currency attractive. I may just find that asset attractive. And that's sort of uncompensated risk that I may or may not want. And today in particular, with Trump coming in and trying to shrink the deficit and so on, might be particularly tactically unattractive, kind of given the outlook for the dollar. So these are all levers that can be used. There are more levers that can be used. At the most extreme, in some ways the best lever that can be used is looking at your portfolio and saying, just what can I do that's the single most diversifying thing? I like it the way it is. I've picked all these assets for a good reason. Every single one of them, I like their returns. They're here for a reason. But they just leave me top of house with a certain amount of vulnerabilities. What should I do to best mitigate them? In other words, let me not rely that the world will stay the way it was, where everything I do for diversification hurts me. Let me bet that it's possible diversification will actually help me, and try to think about what's the most diversifying thing.
So I think that, so to go back to your earlier statement about the fact that for 15 years, one thing worked. So for us as allocators, we constructed these strategic asset allocation portfolios that were heavy on privates, which offers a lot less flexibility to change. So, and given that reality, how do you think about what we should be doing tactically in the part of the book we can actually make an impact on? And do we have to be more dramatic in the marketable side to compensate for there not being a lot we can do on the private side, which is a growing part of people's portfolios?
Yeah, this is a huge, huge point you're bringing up, which is that if you get to the point where, say, 50% of your assets are private, the pace that you can move them, the dynamism you can shift them, just isn't there in the same way. And then you have a lot of different people in the room with different outlays they need to make. But depending on what kind of outlays they need to make, the question of how to do liquidity management becomes tougher and tougher when you're so much in privates. Now, the reality is we've never lived through an equity downturn where people had this much in privates that wasn't just very, very quickly back up. And so if you imagine living through something like 2001 with as many privates as you have today, in 2001, allocators very quickly got back in there and found opportunities. They were very nimble because they had a rebalancing mandate. So as soon as equities fell, they were looking to buy more equities. They found good opportunities. And this was a big thing that happened. It's not going to happen the same way. If you're 50% in privates, you just don't have control that way. So I do feel that the other 50%, first of all, you have to be able to use them to much more dynamically look for opportunities, or else your whole portfolio is stuck. So if you're 50% in privates, you better use your 50% in publics to really be able to have the capabilities to nimbly look for opportunities in a more dynamic way as they arise. The second is that, like you're saying, if you want to shift in any way your risk profile, what you're kind of more vulnerable to, you sort of have to use your public assets to do that. And you have to use your public assets differently than you used to because you have to use them in complement. And so if 15 years ago, you could just look outright and say, what's my best public asset mix? Now you have to say, relative, what's the best complement to all these privates that I've picked and I'm in and I'm kind of there and it'll take me many years to make that change. And so I think public markets are very useful for this. You can go in and out much faster. You can find dynamic opportunities much more quickly, and you can really build allocations that are intended to complement the public ones that you have. I'll give a couple quick examples, which is, we have a number of partners that have sort of said, I like this idea of being more geographically diversified, but there's no way I'm gonna go and build privates capabilities in like lots of different countries in Asia. Like that's just gonna take me years to figure out how to do that. And especially if I go down, private equity, real estate, public credit, it's just gonna be too hard to go build those capabilities. Well, the public markets are the perfect place to say, I just want that complement. I just wanna get that piece, the geographically diversifying. That's gonna be too hard to build in privates, but I can use the public markets more nimbly in order to do that. Second is, we have partners that use us to basically say, how do I get an alternative allocation that its job is to find opportunities more dynamically and more quickly than what's happening in my privates. And then they can kind of choose how much they gear it towards ones that particularly will perform well when their privates do badly or will perform well at all times. And that kind of depends on your governance, right? Because choosing something that'll only do well when your main portfolio does poorly is something that it can be very advantageous, but can also be tough governance-wise. Either way, public markets, we think, and alternatives especially, are just very well suited to be that complement to whatever you have in your privates, and the need for that has gone up a ton as those allocations have gone up.
So clearly, you're arguing for a more diversified public book. As we look ahead to 2025 and beyond, where are you seeing the biggest opportunities and risk in the public markets?
So when I look at the public markets, I kind of look at a lens of, is this a good time to be risk on, risk off? I'd say it's about neutral in my view. It's not a great time to really lean in and take a ton of risk. You already have relatively squeezed risk premiums and so on. But at the same time, policymakers, they want to provide more liquidity, they want to ease more from where they are, and their constraints on doing so are a lot less than they used to. They're in a spot where, it's hard to imagine if there was a meaningful risk to growth that there wouldn't be a lot of Fed easing. They're just not as scared of inflation as they used to be. So I think that sums up to kind of a neutral risk on, risk off perspective. But as I said before, I'd say the US is kind of in the middle relative to other countries in terms of how attractive it is. And so it's an attractive time, in my view, to take risk spread across a lot of countries, especially with the amount of geopolitical tension that we have, the probability that correlations across countries will go down and you'll really get the benefit of that diversification are there. The second is that I think that you're on the margin more likely to get a strong growth and stronger than expected inflation environment. That on the margin, you're gonna get growth a little stronger than expected, but also inflation a little stronger than expected. That means that I like stocks better than I like something like bonds, but within bonds, I like the option value of something like inflation-linked bonds to kind of at least get that CPI if you can. But that could change quickly because with the amount of policy uncertainty you have, it's not hard to imagine one policy change really tilting us in terms of its growth and inflation macro environment with that policy result. So the ability to be more balanced to those outcomes and be able to shift to something that will actually do well if growth is falling, like having a large enough fixed income allocation to benefit from if there does need to be an easing, is real. And then the third is, I think it's a particularly good time to hedge foreign currency exposure. You're just at a time where, if you think about it, if Trump really, really wants to shrink the trade deficit, the thing that's on the other side of that is foreigners coming in and wanting to buy US financial assets, right? That's how the trade and the current account balance. And if he shrinks the trade deficit, he's not doing anything about the desire of other people to buy US financial assets. We're still the center of the financial world. We said US equities are, 2/3, 3/4 of equities out there. People are gonna keep buying our assets. That's a lot of dollar upward pressure to be both shrinking the deficit, the trade deficit, and having people still buy US assets. I think the US economy is still a pretty attractive place to invest. And that means that if you're sitting in the United States today and have a lot of unhedged foreign currency exposure, you probably have risks that you don't want packaged with that geographic diversification you're getting otherwise. And broadly, I'd say the biggest opportunity I see across quote unquote public markets probably is rebuilding the fixed income allocations, because I'm shocked how many people have in their public market fixed income all private credit. And I've kind of said, well, it's not exactly public markets, but it's more liquid than private equity. And I like private credit, there's nothing wrong with that, but obviously that exposure is much more of a credit, growthy exposure that is not doing anything for you in terms of diversifying you in case there's a downturn. So the ability to rebuild that and have uncorrelated alpha in there is really big. And then I'd be remiss not to say this at an event like Global Alts, but look, uncorrelated alpha is the single most valuable thing, the hardest to find thing, because that's the piece where you can make money and not be correlated to all the other risks in your portfolio. So looking for that's the holy grail. And in every piece of your allocation, you should have that. And so you should really be thinking in every piece of allocation, do I have uncorrelated alpha here? If not, how can I find and get it? And not rely on alpha that just kind of re-exacerbates the same biases.
So I'd love to hear a little bit more about because I think you're correct that most of us have not thought, because interest rates were so low, about our fixed income portfolios, our public fixed income portfolios. Are you suggesting or advocating for us to have a broadly diversified fixed income portfolio, both across industries and sectors and geographies? Or do you think that we have to think, or what are the dynamics that we should be thinking about in building a fixed income portfolio right now?
Well, I think that one of the problems with fixed income portfolios is that for many years, the only way to get alpha was to lean in to take more credit risk in one place or another. And again, there's nothing wrong with getting alpha that way. The problem is it's the same type of risk you already have in your equity portfolio. So it could be a great alpha source, but it's not actually diversifying you. And it made sense in an environment where there was no other alpha to be had. But today there is, right? Different countries are easing at different paces. You can actually make money figuring out where do I want to be in the duration curve, which country do I want to be in, looking and saying things like, well, the UK, they're much more likely to have a bond rally because they can't withstand their interest rate level versus Europe or the United States. And so that type of alpha is much more diversifying because it's just something else than what you're getting through credit. And you rely on most fixed income accounts, most fixed income managers are primarily playing credit for alpha. It's just the same exposure you already have. So if what you're trying to do is say, what do I actually have in my portfolio that will do well in a downturn? And you load that area with tons of credit exposure, you're sort of going against what you're trying to do in the first place. Yeah. And it made sense when rates were zero everywhere. There was just no other choice, but today there is.
Right. No, I think that's I think it's an important thing to do. Of course, the big concern is that we have necessarily built out teams to think about things as tactically as that and that have strength in those areas. So we're going to have to lean really heavily on our partners to help us think through some of that. So we are quickly at time. I'd love for you to end with any key takeaways that you want this crowd to walk away with about how to manage through this period of uncertainty. I mean, obviously you've given us a lot of great thoughts around diversification. Is there anything else you think that we should be thinking about as we approach this next 15 years?
It's very interesting because I feel like a lot of the very fundamentals of what will make a market work are what's kind of in question here. The backdrop of the institutions that support marketplace development and whether they'll stay strong and what are the policy levers that are able to kind of support it. And at the same time, the backdrop of any economy at the end of the day is productivity, what makes the economy grow. And with the mix of regulation, deregulation, protectionism, but advantages like AI, that whole mix of things is really potentially shifting the way the economy works and potentially really rejiggering what parts of the world are able to benefit from these things. And so what I'd leave you with is those are a lot of questions, but they really mean you should question a lot of the foundations of what has really made the economy work. They could shift meaningfully in the next 10 years. You could be looking at an economy that just operates differently. And it could operate very differently in different parts of the world as the world gets more bifurcated. And so step back and basically ask yourself, what is my portfolio resilient to? Is it resilient to the more typical stuff like a recession? Is it resilient to a big shift in what part of the world is the winner versus loser? Is it resilient to how the AI revolution might go forward and kind of be ahead of us? Is it resilient to a big shift in productivity? How do I ask these questions in a way that I can be more comfortable that given the range of where the world might go, I'm doing the best I can to not be overly concentrated in one answer, because these are big questions, one we're all going to be thinking about for a long time, but ones that I wouldn't expect we can all predict perfectly.
Right. So please join me in thanking Karen for sharing some very provocative ideas. I think we're all going to go away thinking about what we need to do differently about our portfolios, but it's always a pleasure, Karen. Thank you.
Thank you.